So the big news is that First Republic officially failed, second largest bank failure in history. I want to talk about why it happened. So get into like, well, what actually happened with First Republic and how this is now the third failure that we've seen, how this could impact other banks and then what that might mean. So we're going to unpack all of it. Here we go. So they were lending long. They were giving out mortgages to folks at very low interest rates, high caliber, high credit, high income folks, right? They were a bank that specialized in really good service for very wealthy people. And so that was their sort of their niche. And those customers got very low interest rates on their mortgages, and their mortgages, so they're long-term fixed rate vehicles by and large. And so they did that, and they were funding almost all of it from their own deposits. Now, banks can get funding from multiple places. They need deposits, federal home loan advances. The Federal Reserve runs some things you can do. You can borrow from the Fed in the short term, things like that. You can issue bonds. If you're a bank, you can issue debt and bring cash in that way and then turn around and lend it out. And so here's the thing. They were funding almost all of their long-term loans with short-term deposits, with extra cash that all of these folks had. And so they had a lot of money that was over the FDIC limit. We've talked about that before. Above $250,000, if you get cash in the bank, there becomes a concern that like, well, if the bank goes under, this is money that's above the FDIC limit for me here. It was 68% of their deposits. When I looked up a little bit of research for the video, 68% of their deposits were uninsured. They were over the $250,000 limit. So you had a lot of cash sitting there, and they were paying very low interest rates on that cash over the last many years because interest rates were essentially at zero. And so they were paying almost nothing to get the money in the door and then lending it out at a really low rate, but they had a nice spread there. 50% of their loans were home mortgages with an average rate of 2.89. That's from their fourth quarter filing last year, 2.89%. So that's what they're getting back from the customers, 2.9% interest. That's not smart business, but it's okay when you're paying almost nothing out. They were paying 0.12% before rates started rising on the deposits that they had. So you go, okay, well, there's my spread. You know, most spreads for banks, if you can live in that 2% or higher range, you're going to be all right. You can keep the lights on and pay the employees and run a profitable enterprise as long as you're making good loans. The problem is you've got essentially daily liquidity on these deposits. Customers can pull their money out anytime that they want, and you're locked in long-term on these rates. You can't go back to somebody and say, hey, guess what? Interest rates went up, and I know we gave you the fixed rate, but we're going to need you to pay a little bit more because we're kind of getting into trouble. You can't do that. You're just in trouble. And so what happened was the Federal Reserve started raising interest rates. All of the depositors went, wait a second, we can get better interest rates somewhere else. Maybe we should move this. We like you. You give us great service, but we got all this cash in here. We're going to go make some money from it. And they started pulling it out. Additionally, back in March when the other two banks failed, people started digging around and they went, wait a second, these guys got a lot of short-term cash here and they've lent it out on these long-term mortgages that are locked in at below market interest rates now. This is not going to end well. Maybe we should pull our cash out as a safety measure. At the end of the day, you can't have all of your funding from a short-term liquid people can walk away with it anytime they want and then turn around and lend it out and live to tell a tale about it. It's not great business when interest rates are low. You can be profitable doing that, but your risk is substantial, your interest rate risk, and we've seen that now. The Federal Reserve jumps up interest rates, all of a sudden you got to pay 5% to get money in the door and you're only earning 3%. Not only do you not have a positive spread, you've got a negative spread, and that's exactly what happened here. So a little bit more in depth, I could talk for like an hour and a half about this stuff, but that's the highlights of what's going on. I do want to talk about what that might mean for others. So for other banks, if they're out there and they've got long-term investments. Now, for the first two banks that went, it was treasuries. They bought long-term treasuries. A lot of banks bought long-term treasuries with money because they had excess cash coming in because of all the pandemic money. The system was awash with cash, and so they were taking it in. They needed to do something, and so they buy treasuries with it. If they bought long-term treasuries, like the other two banks did, or you lent the money out at 2020, 2021 rates, and you haven't one way or the other kind of fixed the problem by now, things aren't looking great because you've got to pay, 3, 4, maybe 5% to get money in the door, and you've lent it out and you're earning far less from it. And so your spread is upside down. It's going to take a while for this to settle. The Federal Reserve has done a couple of things to try to calm the markets. The FDIC has done some things to try to calm the markets, but this is not the last bank problem we're going to hear about because as interest rates are much higher now, that's just the world that they live in, and they're all trying to shift gears, even if they weren't as mismatched as First Republic was here with their deposit source and where they were lending or investing money. Even if they're not that mismatched, still risk departments and banks right now are really trying to figure out how to navigate the environment that we have right now with much higher interest rates on the short term. And this is not the last bank in the country that's got a problem like this. And so we'll see where it goes. If you're home watching this right now, this was more for informational purposes, I guess. If you've got more than $250,000, if you're above the FDIC insured limit, go poking around in your bank's filings and just see how things are looking. If you're that nerdy, or do a little bit of research for yourself and see if you might have more risk than you'd be comfortable with there. But for the lion's share of people, I mean, most people aren't sitting on that kind of cash. Not a whole lot to be concerned about here. You might want to understand it. That's why I did the video, but I don't know that there's anything that you should do as a result of this. This is just here you can understand what happened to this place as you see it in all of the headlines. So I hope you enjoyed the video. If you did, go check out the channel. We got lots of stuff out there about all things financial. I thank you for being here, and I'll see you soon.